Biden negotiates raising debt in hopes of averting economic catastrophe. Goldman Sachs pays $215 million to settle a long-running class action lawsuit. The First Republic Bank executives reportedly under investigation. All of these in this week's Weekly Business Briefs. First up, Biden and McCarthy to discuss debt limit as a possible default looms. According to the New York Times, the president will host the House Speaker and other congressional leaders at the White House on Tuesday to discuss their impasses over the debt ceiling and spending cuts. With the Americans and perhaps the global economy hanging in the balance, the meeting will be the first sit-down session between the Democratic president and the Republican speaker since February. But even the terms of the discussion are in dispute. Mr. McCarthy insists the president negotiate a debt ceiling deal with him, while Mr. Biden insists the meeting will just be an opportunity to tell the speaker that there will be no negotiations over the limit. This is going to be a big problem for those of us that have Section 8 housing, right? Government workers, federal workers, if they don't come up with this debt ceiling, if this thing is not solved soon. With the federal government expected to default on this debt as soon as June 1st without an agreement, Mr. McCarthy and his Republican caucus have refused to raise the debt ceiling without commitments to major spending cuts. Mr. Biden said he will discuss ways to reduce the deficit, but has refused to link any spending decisions to the debt ceiling increases, arguing that Congress should simply raise the debt ceiling as it has for generations to pay for spending already approved. In other news, Goldman Sachs to pay $215 million to settle discrimination claims for female employees, reported by CNN. Goldman Sachs has agreed to pay $250 million to settle a long-running class action lawsuit that alleged widespread bias against women in both pay and promotions, a joint statement from the company and the plaintiffs said. The plaintiff's former employee of the Wall Street Bank accused Goldman Sachs of systematically paying women less than men and giving women weaker performance reviews that impeded their career growth. The lawsuit was among the highest profile cases targeting Wall Street's alleged unequal treatment of women in litigation against many banks and stretches back decades. The settlement covers about 2,800 female associates and vice president employed in the investment banking, investment management, and securities division of Goldman Sachs, according to the statement. And lastly, First Republic Bank executives reportedly under investigation for possible insider trading. This is hilarious. Possible insider trading. They were definitely insider trading, in my opinion, here. The Forbes reports that the federal regulators have opened an investigation into former First Republic Bank executives to determine whether they took part in insider trading before the firm collapsed on Monday, according to Bloomberg, in one of the nation's biggest ever banking busts. First Republic's failure has rung alarm bells about the stability of American financial sector, even though Biden administration officials have repeatedly said there is no cause for major concerns, particularly when it comes to the nation's largest banks. First Republic's collapse was the latest in the chain of failures among similar structured regional banks like Silicon Valley and Signature Bank, which were the squeeze of the consequences of the Federal Reserve's continued interest rate hikes. The banks faced major liquidity problems as they dealt with social media-driven runs that led to a rush of customers withdrawing cash, primarily due to the concerns about the firm's heavy investments and deposits into the U.S. Treasuries, which had been seen as a safe investment but lost value as the Feds, and I'm going to repeat this, the Feds rapidly increased interest rates. SVB's failures has also sparked an SEC investigation into possible insider trading, while the former executives there additionally face a Justice Department criminal probe. So, my thoughts on that. The Fed single-handedly, literally created these bank failures. In last week's business brief, I talked about how this is looking a lot like 2008, the 2008 subprime crisis. This is the 2023 banking crisis, but this time the banks are failing because the Feds raised interest rates so hard, so fast, that is causing these banks to fail. And now we're going to be heading into a commercial loan crisis where money, the senior loan officer report just came out yesterday, May 8th, and it shows that we are back, according to the survey taken from the 65 banks, that the lending criterias are just as tight as they were in 2009. They're even tighter than they were in 2020 during the pandemic, guys. I mean, just talk to banks, try to go get a loan right now, and you will see what is happening. Credit criteria have gone up, liquidity criteria have gone up. I mean, everything has just become more and more difficult. And this has been your weekly business brief. I'll see you guys next week. Don't forget to like and subscribe to keep up with the latest business updates. Peace out, guys.